We all know that at different stages of life, investors need to consider perhaps different types of financial goals. During retirement, generally speaking, earning a regular income from investments is a top priority. According to our next guest, RELPs, or Real Estate Limited Partnerships, actually got a bit of a ring to it, can help investors do just that. John Nicola is CEO and chairman of Nicola Wealth. Welcome to you. Good to have you join us. Your company does a variety of different formats and manages different types of assets, but we'll talk about RELPs and how they are different. They're sort of pools rather than REITs. Tell us about some of the differences and why they might be interesting to different sets of people.
So RELPs are pools of private capital that focus exclusively on real estate. They could be project-oriented. They could decide to invest, for example, in a single building, in potentially a condo development, which would be higher risk. They could buy apartment buildings, or they could have a multiplicity of assets. So in some ways, they look like a real estate investment trust, but they're not publicly traded. They tend to have higher minimum investments, typically.
What would be a minimum investment? Average?
I would say realistically probably $25,000 would be a minimum. It is designed supposedly for sophisticated investors, but I think there are some companies around that offer investments, like some of the large insurance companies have taken their assets that own direct real estate, and in some cases multi-billion-dollar portfolios, and they brought them into what are called segregated funds. They're similar to RELPs. They're not publicly traded REITs. They own the actual real estate. And the important distinction between them is that while the rates of return over a long period of time, like we took a look at the last 15 years, for example, and REITs and real estate limited partnerships had almost identical rates of return. But the real estate limited partnerships achieved it with 1/4 of the volatility. So when people are getting ready for retirement, they are concerned.
And is that because they're just not exposed essentially to the overall stock market rises and falls?
That's right. So, and the stock market rises and falls are effectively the result typically of emotional behavior. So here's one example. In 2008 and 9, during the financial crisis, when you took a look at actual transactions in Canada involving real estate, prices changed basically about 4% over that 2-year time frame. So that's not a lot of volatility. But real estate trust prices changed by 93% over the same 2 years. So they both own exactly the same kind of real estate. So REITs were affected by individuals' behavior. In 2008, they were selling, and the market dropped 38%. In 2009, they were buying, and the market went up 55%.
So a very different structure for the same underlying assets.
That's correct. A lot less volatility if you can get into the RELPs.
But that said, it's not really for the retail investor. It's not for the faint of heart, but kind of for different reasons. And is it mostly the upfront cost? Would that be part of it?
No, they're not upfront costs. Really, the issues are transaction costs or transaction issues in terms of administering for the person that's managing the RELP, smaller investors. You know, there's an entire industry for mutual funds designed around investors to put in $500 as a minimum. That kind of scale and technology doesn't exist for real estate limited partnerships. So they limit themselves to investors who are willing to put up larger amounts of money.
You have a few tips if people want to be taking a look at this type of investment. The first is reading the offering memorandum, which is always an obvious thing to say, but what is it that perhaps is even more important about this type of investment, and reading the back pages?
And of course the offering memorandum might be 60 or 70 pages, which is really a challenge to get through. But the first thing you should go for is to look at the fee part of the report, which is maybe not that long, and look and see, are the fees that are being charged reasonable? You need to take a look and find out what the terms are for liquidity. In other words, you know how you're going to buy, but is it explained how you're going to sell when you want to sell? You should look at the reputation of the general practitioner, of the general partner, I should say, and make sure that they have some kind of a track record for their history that they've had in the real estate industry. And doing all of those things will increase the likelihood that you'll get the result that you want.
What about taking a look at leverage? How much debt is applied to the investment?
Yes, most limited partnerships will outline what the maximum leverage can be. So I would say that any limited partnership that has more than 70% leverage is taking on unnecessary risk. Ideally, I would think in this environment, maybe 50 to 60% leverage would be ideal.
Okay, John, thank you very much for coming in and telling us about RELPs.
Thank you.
I'll remember them better now. That's John Nicola. He's CEO and the chairman of Nicola Wealth. Joined us here.